Chanda Kochhar, the MD and CEO of ICICI Bank, is confident about maintaining margins in the coming quarters and is betting big on the growth prospects in rural India. Our stocks editor Nikunj Dalmia caught up with Chanda Kochhar on the sidelines of the Motilal Oswal Investor Conference. Let's hear an excerpt.
Well, actually, we had started seeing increase in the wholesale deposit rates almost a month ago. This is really a culmination of that on the retail sides also deposit rates increases have been announced. In a way, it's the result of the fact that a lot of excess liquidity from the system has disappeared. So it's just mirroring whatever is happening on the demand-supply side, on the liquidity side.
So in an environment when deposit rates are moving up, are you confident you would be able to protect your NIMs?
Yes, because gradually I think lending rates will also go up in the system. Always the lending rates go up with a lag, so we are already seeing therefore an upward bias on the lending rates. But the second half of this year you may see some impact on the lending rates, and I think that's the way NIMs will be maintained. Specifically for ICICI Bank, we are of course very consciously working on increasing our CASA deposits, on further optimizing our funding base, and that will help us maintain the NIMs as well.
But if I look at the industries, large cap banks, small cap banks, there has been a NIM expansion, but on a quarter basis, your NIMs have come down marginally though, but they've come down.
Quarter-on-quarter basis, yes, because the end of the year, that is by March, you build a large amount of priority sector portfolio which comes at lower margins, and that stays with you during the first quarter. So you've always seen that the first quarter NIMs are lower than the quarter 4 NIMs. But if you compare the same quarter last year, then actually there is an improvement in net interest margins.
One thing which has worked like a charm for you, at least in the quarter gone by, NPAs, the NPA levels have come down. Was that a one-off because of better recovery, or this is sustainable in nature where quarter-on-quarter basis NPAs will come down?
This is clearly sustainable because this is the result of whatever we've done in the last 4 to 5 quarters, that is consciously brought down our unsecured retail loan book. And as you're aware, that was the largest contributor to NPAs and to credit losses. So with that book coming down, our addition to NPAs has been coming down on a quarter-on-quarter basis, and that is translating to lower NPAs and to lower provision charges. And you will see the benefit of that further showing in the next few quarters as well.
Your provisioning for the quarter gone by also has gone down substantially. So yes. Is this beginning of a trend that you will not be providing more?
Yes, it's clearly, therefore, is an indication that the peak of credit losses and the provision requirements is behind us, and from here on there is only some improvement.
You mentioned the word retail on the sidelines of your numbers and in the conference call as well. Are you revisiting the retail sector aggressively?
There is no change in our approach from what we have been saying for the past 1 year. We have been clearly saying that we want to bring down the unsecured retail book, but we want to grow the housing and the car loan book, and that's essentially what we are doing. Our reduction of unsecured retail book has largely been achieved. So now our unsecured retail book is just about 3 to 4% of our total loan book, and that is a nice sustainable level for it to stay. And the housing book and the car loan book will increase from here, and therefore net now you will see an increase in the retail book.
So if I have to cluster the various verticals, rural, corporate and retail, which to your mind would be the biggest impetus for ICICI Bank, first in the short term and then in the medium term?
All three will be an impetus, because I think on the corporate side we are seeing a lot of investment activity coming back, and we've been leaders in project finance, so that will be an impetus. On the retail side, as I said, there'll be focused growth on housing, car loan and commercial vehicle loans, and rural is, I think, the next big growth opportunity for India, and we are really focusing on financial inclusion in a big way. So all three areas are really going to be growth areas for us.
The non-banking business part now, in the conference call you indicated that your insurance margins will come down because of the new ULIP norms. Is that a big concern?
First of all, I think all the changes and the norms that have been announced in the industry are, I think, very good for the industry and for the customer on a long-term basis. Structurally, they will drive the industry to a very sound structure. Now, it does mean that in the immediate term, the companies will have to go through the adjustment period of adjusting their business plans. I again think that the industry will still grow on a robust basis, though every company in the industry will have to work their specific strategies as to how to maintain margins. And clearly the strategy that we have in mind, which will mean a huge amount of improvement in productivity that we will work for, cut in various costs and so on, would still mean maybe some impact on the margins, but not a large impact on the margins. And we still believe that the company will, for the year as a whole, remain in the profit zone.
But a ballpark number, if you could share with us, what could be the margin hit in the insurance business?
So far, we have been operating at a margin of about 19%. The way we are working our business plans now is to see how we can operate between 16.5% and 17%.
8 months ago on a similar conference, I'd asked you the question on your plans for ICICI insurance listing, and that time you had mentioned that yes, you were considering something. Has that plan gone on a back burner now?
On a medium-term basis, clearly that plan would still stay, because at some point in time we will look at monetizing some amount of our investment in the insurance company. But I think this is not the right time, because given the changes in the insurance industry, we'd rather wait for the new business model to settle down completely, for the stability of the margins, etc., to become more visible. And in any case, as I said, that we believe the company will continue to remain in the profit zone, so therefore it will not really require any incremental capital from us. So we would rather wait first to stabilize the new model, and then to look at monetizing at times where we get even more optimum value from what we would get currently.
So can I safely assume that it's not going to be 2011 or 2012, anything beyond 2012, you would consider listing of your insurance business?
Well, I think it will not be 2011. Beyond that, it's too long term to really comment.
But have valuations for the insurance business come down for the industry per se, not for ICICI Bank, but for the industry?
I think currently the period is more where people are still trying to grasp what the impact of the new model would be. So, what needs to be understood is whether there will be an impact on the top line, whether there will be an impact on the bottom line. So I think currently everybody is kind of trying to understand that. It's too early to say whether all that understanding has translated into the valuation models already or not.
ICICI Securities, a small business for ICICI Bank, but any plans to list that? Because there were some initial indications in 2008 that the bank was considering listing ISEC.
It's a small business for us, but it's a very growing and a profitable business for us. Again, that business currently at this rates of profits does not need any new capital. So as of now, there are no such plans on the cards.